Most beginners don't lose money because the stock market is bad. They lose money because they make simple mistakes nobody warns them about. Today, I'm going to show you the 5 biggest stock market mistakes beginners make. And honestly, I made some of these mistakes myself. If you avoid just one of these, you could save yourself months or even years of frustration. And remember, this video is for educational purposes only, not financial advice. Always do your own research before investing. Let's start. Investing looks easy when you watch successful investors online. You see green charts, big profits, and people talking about financial freedom. But what you don't see are the mistakes beginners make in the early stages. Most new investors focus on finding the perfect stock, but the truth is success comes from avoiding common mistakes. So let's break down the biggest beginner errors, step by step. Mistake number 1: investing without a plan. The first mistake beginners make is investing without a clear plan. They open a trading app, buy random stocks they heard on social media, and hope for fast profits. But investing without a plan is like driving without a map. Before investing, you should ask, what is your goal? Are you investing long-term or short-term? How much risk can you handle? Without answers to these questions, every decision becomes emotional instead of logical. Successful investors don't guess, they follow a strategy. Mistake number 2: putting all money into one stock. This is one of the most dangerous mistakes. Many beginners believe they can find one perfect stock that will change their life, so they invest all their money into a single company. But what happens if that company drops? Your entire investment drops with it. This is why diversification exists. Instead of putting everything into one stock, spreading your investment across different sectors reduces risk. Even if one stock performs poorly, others can balance the portfolio. Mistake number 3: following hype in social media. Social media is full of people saying, "This stock will explode. This is the next big thing." Beginners often chase hype because they fear missing out. But by the time something becomes viral, many early investors have already made their profits. Smart investing requires research, not hype. Always ask, does the company have strong fundamentals? Is the business growing? Does the valuation make sense? If the only reason you're buying is because someone said it's going to the moon, that's not investing, that's gambling. Mistake number 4: panic selling during market drops. Market drops are normal, but beginners panic when they see red numbers. They sell quickly because they think the market will crash forever. The reality is, markets move in cycles. Ups and downs are part of investing. Many successful investors focus on long-term growth instead of short-term fear. Selling during emotional moments often locks in losses instead of allowing recovery. Mistake number 5: trying to get rich quick. This might be the biggest mistake of all. Beginners want fast profits. They look for penny stocks or risky trades, hoping to double their money overnight. But real wealth is usually built slowly through consistency. Investing is not about speed, it's about discipline. Small, consistent investments over time often outperform risky short-term decisions. Important lesson: if you remember only one thing from this video, remember this. And again, this video is for educational purposes only. It is not financial advice. Always do your own research and consider your personal financial situation before investing. If you learned something new today and want to invest smarter, hit the like button and subscribe to Truelytics. And tell me in the comments, which mistake surprised you the most? Because understanding mistakes is the first step towards becoming a better investor. I'll see you in the next video.